Welcome to the Deep Dive. Today, we're taking a plunge into a book that completely flipped my perspective on spreadsheets and instead made me look inward. We're doing a deep dive into The Psychology of Money by Morgan Housel.
It's a truly unique blend, isn't it? Taking the often dry, technical world of finance and overlaying it with the incredibly messy, emotional, and, well, deeply human elements of our behavior.
Exactly.
It's not just about interest rates or market cycles.
Absolutely. This isn't your typical how-to-get-rich guide filled with formulas or, like, stock picks. It feels much more like a why do we act this way with money exploration.
Hmm.
Our mission in this deep dive is to extract the most important insights, the surprising facts, and maybe those aha moments that truly explain our sometimes baffling relationship with money.
Because at its core, the book argues that financial success isn't just about your IQ or, knowing intricate financial models.
And that's where it starts, right? The idea that financial success is actually quite counterintuitive. Housel suggests it's much more of a soft skill than a hard science.
Precisely. The central thesis is that your financial outcomes are determined far more by how you behave, your psychology, your temperament, your reactions,
Yeah.
than by what you know about finance.
It's behavior, not just brain power.
Yeah, exactly. Behavior.
And the stories he uses to kick this off are pretty eye-opening. There's that anecdote about the incredibly intelligent tech executive he encountered as a valet,
Oh, yeah.
someone who's literally throwing gold coins into the ocean for fun, and then, like, casually paid a hotel manager $5,000 for breaking a cheap lamp, telling him not to insult him with a smaller fee. Just wild.
Wow. And compare that with the story of Ronald Reed, right? A guy who worked as a janitor and a gas station attendant his whole life.
Mm-hmm.
And by the time he passed away, he'd quietly built a fortune worth over, what, $8 million?
$8 million, yeah.
Yeah.
And his approach was incredibly simple.
Yeah.
Live frugally and just invest consistently in basic blue chip stocks for decades.
It makes you stop and think, doesn't it?
It really does. You don't hear stories about janitors outperforming Nobel laureate physicists or, short order cooks being better brain surgeons than Harvard specialists.
Right. Those fields demand a very specific, demonstrable technical genius.
But in finance, stories like Ronald Reed's existing alongside reckless executives are possible. It happens.
And this strongly suggests that financial results are heavily influenced by factors beyond just your intelligence or how hard you work.
Right.
Things like luck, certainly, which the book definitely gets into, but maybe even more significantly, your behavior, your discipline, your patience, your emotional control, all that soft stuff.
Hales draws this fascinating comparison between the financial industry and the healthcare industry. Healthcare has seen massive scientific advancements over the last century. New treatments, new understanding of disease, leading to dramatically increased life expectancy and, well, just better health globally.
Huge leaps forward, yeah. Undeniable progress.
Yet the money management industry, despite attracting some of the brightest minds, developing incredibly complex models and theories, it hasn't resulted in a clear, widespread improvement in personal financial well-being for the average person.
That's a really good point. I mean, are people less burdened by debt today, more likely to save adequately? Do we have healthier psychological relationships with money?
The book argues the evidence for that kind of collective financial improvement just isn't nearly as strong as the evidence for collective health improvement. And Housel posits this is largely because we've treated money too much like physics, assuming universal rules and predictable outcomes.
Like it's all formulas and constants.
Exactly. When we should be treating it more like psychology, acknowledging the chaos, the emotions, the personal biases involved. It's messy.
Yeah, the technical side of finance is necessary, obviously. You need to know some basics. But it's insufficient on its own. Knowing the optimal strategy from a spreadsheet doesn't guarantee you'll actually be able to do it when fear or greed kick in.
Oh, absolutely. Which brings us to another major theme that really resonated with me. The profound, almost invisible impact of our personal history on our financial lives.
Yes.
This idea that our unique experiences, especially when we're young, fundamentally shape our decisions and how we view risk.
There's a powerful study Housel references by economists Ulrich Malmendier and Stefan Nagel. Have you seen that one?
I think so, yeah. They looked at the survey of consumer finances.
That's the one. They analyzed decades of data and found this striking correlation. People's lifetime investment choices are heavily anchored to the market performance and inflation rates they experienced growing up.
So if you grew up during a period of high inflation, you might be less likely to invest in bonds later in life, even if bonds seemed like a sensible choice at that particular time.
Exactly. Or conversely, if you came of age during a strong bull market, you might be way more comfortable taking on stock market risk later, maybe even too comfortable sometimes.
Their conclusion was pretty direct, wasn't it?
It was. They basically said individual investors' willingness to bear risk depends on personal history. And they pointed out that this isn't about how smart you are or how much financial education you have.
Right.
It's the dumb luck of when and where you were born. Your personal economic environment just shapes your baseline beliefs about how money works. It seeps in.
The Bill Gross story illustrates this perfectly. He's, the legendary bond investor.
Right, the bond king.
And his career coincided almost perfectly with this massive generational decline in interest rates. So to him, bonds were these incredible wealth-generating machines.
Yeah, he rode that wave brilliantly.
But Housel notes that for his father's generation, who lived through periods of much higher inflation where bond values got hammered, they might have seen bonds as wealth incinerators. Same investment vehicle, totally different perception driven purely by lived experience.
It's fascinating, and you see this even more starkly when you consider the difference in experiences during, say, World War II. People in Germany and Japan saw their stock markets essentially wiped out, their economies devastated. Meanwhile, the U.S. stock market doubled, and the economy boomed.
How could anyone expect individuals from those vastly different historical contexts to hold similar views on markets, inflation, or financial risk afterwards? You just wouldn't.
You wouldn't. And these personal histories, these small, limited slices of global economic reality that we each inhabit, they help explain financial behaviors that outsiders might deem completely irrational.
Like the book's example of people with very low incomes buying lottery tickets.
Yeah, from a purely mathematical standpoint, it's objectively a terrible investment, right? The expected return is negative. The odds are minuscule.
Terrible odds.
But the book offers this crucial perspective. For someone living paycheck to paycheck, maybe facing significant systemic barriers, with limited realistic prospects for substantial wage increases or accumulating savings. A lottery ticket might represent perhaps the only tangible, accessible dream of achieving the kind of financial comfort that others take for granted.
They aren't buying a stake in a company. They are, as Housel puts it, paying for a dream. It makes a strange kind of sense from that perspective.
And that's the profound insight, I think. What you're doing seems crazy, but I kind of understand why you're doing it.
Yeah.
So many financial decisions aren't made in a spreadsheet vacuum. They're made in the context of your personal history, your ego, your pride, your unique incentives, and the narrative you've constructed about your life and prospects. It's all woven together.
And another example Housel uses to show how recent history shapes our expectations is the whole concept of widespread retirement.
Oh, yeah, that's a big one.
The book points out that the idea of most people retiring comfortably for 20, 30 years in their 60s is, historically speaking, brand new. Like maybe only 2 generations old, max.
It really is. Before World War II, the reality for the majority of Americans was simply working until they died.
The numbers back that up, right?
Totally. Labor force participation for men 65 and older was consistently above 50% until the 1940s. Social Security was created, sure, but its initial benefits were minimal. It was never intended to fully fund retirement.
And the average Social Security check didn't even pass the inflation-adjusted equivalent of like $1,000 a month until the 1980s.
Exactly. And this idea that everyone had a gold-plated private pension in the past, that's also largely a myth.
Really?
Yeah. In 1975, only about a quarter of people over 65 had any pension income at all, and it was typically a pretty small portion of their overall income.
Wow. So our modern expectation of retiring relatively young and living comfortably without working for decades.
It's anchored in a reality that simply didn't exist for most people just a few generations ago. It's a testament to recent progress, for sure, but it also highlights how quickly our expectations can normalize around a very new historical norm.
Okay, let's talk about the siblings Housel introduces. Luck and risk.
Ah, yes, the inseparable twins.
Forces that seem to operate beyond our individual control, but significantly influence outcomes. Scott Galloway's line, "Nothing is as good or as bad as it seems," feels like it fits perfectly here.
It really does. And this is where disentangling skill from chance becomes incredibly difficult, especially when you look at extreme success or failure. Housel uses the remarkable story of Bill Gates' early access to computers.
Yes. The fact that in 1968, when Gates was just a teenager, he attended one of the only high schools in the entire world that had a computer terminal linked to a time-sharing system.
And crucially, it was part of an independent study program that allowed Gates and his friend Paul Allen basically unlimited, unsupervised access to just explore and code at a time when computer time was incredibly scarce and expensive.
Housel breaks down the statistical improbability, doesn't it?
It does. In 1968, there were roughly 303 million high school-age kids globally. Only about 300 attended Lakeside School. The odds of attending that specific school were literally 1 in a million. That access, that unique opportunity, it played a massive role in his development and, what came next.
And then there's the poignant mention of his close friend Ken Evans, who is just as talented and ambitious,
Yeah.
who died tragically in a climbing accident. They were partners. They would have kept working together. It's just a stark reminder of how quickly unforeseen events, pure chance, can alter paths.
It really underscores how much of Gates's early trajectory was tied to luck, the right school, the right time, the right opportunity, alongside his undeniable talent, of course.
Which makes the line between bold and reckless incredibly thin, doesn't it? Often only visible in hindsight because of the unpredictable nature of luck and risk.
Absolutely. The story of Cornelius Vanderbilt building his railroad empire is a prime example. He was famously dismissive of laws.
His quote is kind of infamous. You don't suppose you can run a railroad in accordance with the statutes of the state of New York, do you?
Right. He was incredibly successful, and looking back, it's tempting to label that boldness or genius.
Recommending people just flout the law as a financial strategy is obviously absurd. You can easily imagine a different reality where Vanderbilt ended up in jail and his empire crumbled.
Totally. As Housel points out, his follow-up quote, "Ain't I got the power?" Sounds great when you're winning, but man, it carries immense risk. One wrong move.
And even Benjamin Graham, the revered father of value investing, had his success heavily skewed by one single holding, Geico.
That's right. Housel notes that Graham's massive profits from Geico actually broke his own diversification rules.
Irony.
And Graham himself later mused, one lucky break or one supremely shrewd decision, can we tell them apart? Housel's answer is, often we cannot, not easily anyway.
This difficulty in distinguishing luck, skill, and risk makes it really challenging to figure out what constitutes best practice in finance. Like, who do you emulate?
Exactly. The wildly successful risk taker who might have just gotten incredibly lucky,
Yep.
or the cautious investor who might have missed out on huge opportunities.
Housel suggests focusing maybe more on studying the average outcomes and common behaviors like Frederick Lewis Allen did, rather than just fixating on the extreme outliers.
Because those extreme successes and failures, often driven by luck, they can be hard teachers. Bill Gates himself said, "Success is a lousy teacher. It seduces smart people into thinking they can't lose."
Right. If luck played a big role in your success, it can make you feel invincible, blindsiding you to the very real risk that can reverse fortunes just as quickly.
And failure can be equally misleading, can it? It can convince you that your decisions were fundamentally terrible, when in fact they might have just been subject to risk that didn't play out in your favor this time. Housel's point here is crucial. With failure, the key is to arrange your finances so that one bad outcome doesn't completely wipe you out. You need to be able to stay in the game.
Survive.
Survive, exactly. So you can benefit when the odds eventually swing your way. And, he adds, you need to be able to forgive yourself for mistakes that were the result of risk, not necessarily terrible judgment. Leave room for error.
This concept of staying in the game, of survival, leads directly to another powerful idea, the problem of never enough.
Oh, yeah? This one hits home.
The book highlights this with extreme examples like Rajat Gupta or Bernie Madoff.
Right. These were men who had achieved extraordinary success, accumulated immense wealth, more money than they could ever possibly need.
Yet they risked absolutely everything, their freedom, their reputations, their relationships for more. Gupta with insider trading, Madoff with decades of fraud. From the outside, it just seems utterly illogical.
It does, and it brings us to what Housel calls a simple, powerful principle, but one that's often overlooked. There is no reason to risk what you have and need for what you don't have and don't need.
It sounds so obvious when you say it like that.
Doesn't it? But this principle is incredibly relevant to you listening right now. Most of us, at some point in our lives, will probably earn enough to comfortably cover all our reasonable needs and quite a bit of what we simply want.
The hardest financial skill isn't necessarily making more money. It's getting the goalpost to stop moving.
That's the real challenge. If your expectations keep rising along with your income and results, you never feel like you've actually reached enough.
Right. Ambition outpaces satisfaction. You always feel like you're behind.
And that feeling can pressure you into taking greater risks just to catch up to a perpetually moving target. It's a dangerous cycle.
Capitalism is a magnificent engine for generating wealth, but man, it's also incredibly effective at generating envy.
Oh, yeah. Comparison is baked in.
And while some envy can be a productive motivator, maybe pushing you to work harder, life satisfaction really requires a sense of enough. Happiness equals results minus expectations, right?
That's the formula. And social comparison fuels this endlessly. Housel gives that example of a rookie baseball player making, say, $500,000 a year feeling broke compared to Mike Trout making hundreds of millions.
And Mike Trout potentially comparing himself to hedge fund managers making billions. It never stops.
It really doesn't. The comparison game just scales up.
Housel defines enough not as being conservative or unambitious, but as recognizing that an unchecked appetite for more can push you past a point of regret.
Yeah, whether that's working yourself into burnout, taking on reckless financial risks that blow up in your face, or, in the most extreme cases, resorting to unethical or illegal stuff.
He likens it to eating until you're sick versus stopping when you're full.
That's a great analogy. The regret of overconsumption, whether it's food or risk, far outweighs the fleeting pleasure of those extra bites.
And yet, this simple truth about enough seems so incredibly hard for us to internalize when it comes to money and ambition. It's like a core human struggle.
Which leads us beautifully to another core concept Housel unpacks: the profound, non-intuitive power of compounding and the absolutely essential necessity of survival for compounding to actually work its magic.
Right. He argues that longevity in the market often trumps achieving incredibly high returns.
Yeah. The classic example is, of course, Warren Buffett. At the time the book was written, his net worth was around $84.5 billion. But an astonishing $84.2 billion of that was accumulated after his 50th birthday.
That's mind-blowing.
It gets crazier. Like $81.5 billion came after he started collecting Social Security in his mid-60s.
It's easy to look at Buffett and just say, well, he's a genius investor. And yeah, obviously he is.
He is. But Housel's point is that the real key to his incredible wealth isn't just achieving high annual returns, it's achieving good returns consistently for 3/4 of a century.
The time factor is enormous.
Huge. If he had started in his 30s and retired in his 60s, like most people aim to, he would likely be a relatively unknown name in finance circles, despite being a great investor.
Compare him to someone like Jim Simons, right?
Yeah.
Runs Renaissance Technologies.
Yep. Simons has compounded money at an astronomical average rate of 66% annually. Just staggering return.
Way higher than Buffett's roughly 22% over his career.
Vastly higher. Yet, Simons is significantly less wealthy than Buffett. Why? Because he didn't start that incredible run until he was around 50. He had less than half the time for compounding to work its magic on a really large scale.
Housel uses that hypothetical calculation. If Simons had managed 66% for 70 years.
The number is just utterly ridiculous, isn't it? Like $63 quintillion or something. It just highlights how small changes in growth rates, sustained over enormous periods, produce numbers that completely defy our intuitive understanding.
We tend to think linearly, 8 plus 8 plus 8. Exponential growth is different. 8 times 8 times 8.
Our brains aren't naturally wired for it, so compounding results always kind of surprise us. Housel even uses the example of Bill Gates initially underestimating how much storage people would eventually need for email.
Right. Thinking in terms of past scarcity.
Exactly. Not grasping the coming exponential growth. Even geniuses struggle with it sometimes.
And this brings us to that critical distinction Housel makes. Getting wealthy versus staying wealthy.
Yeah, he calls staying wealthy the single most important word in finance. Survival.
They are two completely different skill sets, aren't they?
Totally different. Getting wealthy might require taking risks, being bold, having optimism. But staying wealthy, that requires a different mindset altogether, a combination of frugality and, honestly, a certain level of paranoia.
He contrasts Jesse Livermore, arguably the greatest trader of his era,
Made billions shorting the market in the '29 crash. Brilliant timing.
with Abraham Jermansky, a real estate multimillionaire who got wiped out in the same crash. Livermore was brilliant at getting wealthy. Jermansky maybe less so in that moment.
But their paths converged just 4 years later. Right?
Yeah. Livermore, incredibly overconfident after his 1929 success, took even bigger, riskier bets, lost absolutely everything.
And tragically took his own life.
So both were great at accumulating wealth in their respective fields, but equally terrible ultimately at preserving it, at staying wealthy.
Survival is just paramount because it's the only way compounding can continue to work. Housel points to data showing that even 40% of public companies eventually see their stock lose virtually all value.
Wow, 40%.
Yeah. And the Forbes 400 list has significant turnover. Michael Moritz of Sequoia Capital attributes their venture firm's 4 decades of success to a constant, ingrained fear of going out of business.
Like Andy Grove said, only the paranoid survive.
Exactly. Longevity isn't just a nice-to-have. It's the absolute bedrock of wealth accumulation through compounding. It allows your assets the years and years and years they need to truly grow, like planting oak trees, as Housel puts it.
And he notes that while it's hard to perfectly replicate how Buffett invested, it's much easier to identify and emulate what he didn't do.
Right, like avoiding the kind of ruinous leverage that wiped out his friend Rick Guerin in the 1970s downturn. Survival matters most. You have to avoid the catastrophic mistakes.
And this absolute necessity of survival, combined with the unpredictable nature of the world, means that while planning is vital,
You have to plan.
the most important part of any plan is planning on the plan not going according to plan.
That's the key insight, isn't it? Just look at the last couple of decades. Housel lists events like 9/11, the housing bubble and bust, the global financial crisis, the COVID-19 pandemic.
Things that had massive economic consequences.
Huge. And were virtually impossible to foresee or predict the scale of beforehand.
A robust financial plan doesn't rely on predicting the future, then.
No, it embraces the unknowns and emphasizes room for error. Fragility increases when your plan requires very specific outcomes to hold true.
So you need margin.
Exactly. Having enough margin, enough savings, conservative projections, so that your plan still works, even if, say, market returns are half of what you expected. That makes your plan far more valuable in the real world. It makes it resilient.
It's about building in a margin of safety, not just for risks you know about, but for the things you can't possibly imagine. Housel shares that bizarre historical anecdote.
Oh, the mice.
Yeah, German tanks being defeated in the Battle of Stalingrad because mice chewed through their electrical wiring. A completely unforeseeable vulnerability having a catastrophic impact.
You see similar unforeseeable crises in business all the time. Unexpected lawsuits, supply chain disruptions, a key customer going bankrupt, a founder having a mental health crisis, a data breach. Stuff happens.
The defense against these unknowns is avoiding single points of failure, building in redundancy, having that room for error.
Just like engineers build redundancy into airplanes and bridges, you need backup systems.
So saving money isn't just about earmarking funds for known future needs, like retirement or down payment.
Right. It's also building flexibility for the unknown, the things you can't even put a name to yet. As Housel stresses, planning on your plan not working exactly right is the most crucial element. You need that cushion.
Okay, let's talk about tails drive everything.
The power of the extremes.
This is the idea that in finance and investing, the most extreme outcomes, the really big wins and the really big losses, have a disproportionate impact on the overall results.
Housel uses that analogy of brain development. As a child grows, they actually lose billions of synaptic connections, a process of, like, destruction. Pruning, exactly. But this pruning of inefficient pathways leads to a much smarter adult brain. Growth often happens alongside destruction or weeding out.
And this applies to economies and markets too, right? The U.S. economy has grown dramatically over 170 years, but that growth occurred despite depressions, recessions, wars, countless market crashes.
Yeah, the long-term trend is up, but the short-term is often a mess.
The key insight is that long tails, the far ends of the distribution, the extreme successes and failures, are what truly drive the overall results. Housel gives the example of that art dealer, Einsberg Ruin.
Right. He acquired countless works, and probably 99% ended up being worth very little. But the tiny fraction that turned out to be Picasso's or Matisse's.
The home runs.
Exactly. They accounted for virtually all of his eventual massive wealth, just a few key pieces.
Venture capital is a perfect example of this too.
Oh, textbook case. Studies show that the vast majority of VC fund returns come from a tiny percentage of their investments. Maybe 1% generating 20x returns or 0.5% generating 50x plus.
Most startups fail, but the handful of extreme winners generate the entire fund's success.
It's why VC is inherently risky. It relies on finding those tails.
And this is also true in the broader stock market, that Russell 3000 index example.
Yeah, representing like 98% of the U.S. market. It's had spectacular returns over decades.
But Housel points out that 40% of the companies in that index saw their stock value fall by 70% or more and never recover.
40% just basically failed as investments. But the market's overall success was driven by a small number of outlier companies, the Microsofts, the Walmarts, the Amazons. The huge winners pulled everything else up.
And this understanding of tails really changes how you should view financial advice, doesn't it?
It really should. Most advice focuses on the day-to-day, what's happening now, what stock to buy today, what the market did yesterday.
Right.
But Housel argues that what matters most over a lifetime isn't what you do on the average day, but what you do during that tiny fraction of days, probably less than 1% of your investing lifetime, when everyone else is panicking or behaving irrationally.
So an investing genius, by this definition, isn't someone who is right all the time.
No way.
It's someone who can manage to do the average sensible thing when everyone else is losing their minds during one of those critical tail events like a major crash or bubble.
Exactly. Just not panicking is maybe the most valuable skill. And because tails drive everything, it is normal for most individual endeavors to fail or underperform.
Most stock picks won't be huge winners. Most business ideas won't become giants.
Right. Housel notes that even Peter Lynch, one of history's greatest investors, said he was only right maybe 6 out of 10 times.
Wow. Only 60%.
Yeah. Investing in business aren't like flying a plane where you need almost zero mistakes, or being a chef where you need to be pretty good consistently. It's okay to be wrong often, as long as you're right big when it matters and your losses are controlled. You need those occasional big wins.
Housel highlights how leaders at companies like Amazon or Netflix seem to understand this.
Yeah, they acknowledge that projects like the Fire Phone or all the shows Netflix cancels are failures.
Right. Expensive failure sometimes.
But they view them as necessary costs of trying to find the next tail success, the next AWS or Orange is the New Black. They aren't deluding themselves. They're acknowledging the reality of how innovation and tails actually work. You have to take shots.
It's hard for us to internalize this, though, because we usually only see the finished product, the smash hit show, the perfectly delivered comedy special.
Exactly. We don't see the dozens of jokes that bombed in small clubs or the pilot episodes that never aired. We miss all the failures that led to the success.
As George Soros famously said, it's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong.
That's the key. You can be wrong half the time and still build significant wealth if your winners are allowed to run and your losers are cut relatively quickly. Manage the asymmetry.
And this leads right into the idea that market returns are never free. Volatility, uncertainty, upheaval, that's the price you pay.
Yeah. Housel frames volatility not as a fine, like a punishment for doing something wrong.
Which is how it often feels.
Totally. But he frames it as a fee. It's the cost of admission to get the potential rewards the market offers over the long term.
Like paying for a ticket to an expensive amusement park. It might hurt to hand over the cash, but it's the necessary price for that specific experience, for the potential fun inside.
Precisely. He uses examples of stocks that have delivered incredible returns, like Netflix or Monster Beverage. They have spent the vast majority of their trading days below their previous all-time highs.
So lots of drawdowns, lots of feeling like you're losing.
Yeah, that constant up and down, that stomach-turning volatility, that is a price of admission you paid if you held them for the long run and got those huge returns. It wasn't a smooth ride.
You have a choice then.
You do. You can pay the fee and accept the volatility for the potential higher returns. You can choose assets with a lower fee, but also a lower potential payoff, like cash or bonds. Or you can attempt what Housel calls grand theft auto, trying to get the returns without paying the volatility fee.
Which sounds great, but
It's impossible in the long run, right? It often involves deception or unsustainable leverage, like some of the accounting tricks House mentions. It doesn't end well.
so the key takeaway is you don't have to pay the fee. You can stay safe.
Right.
But if you want the magic of higher returns over time, you have to accept the price of admission, which is volatility and uncertainty.
And the goal is to train yourself to see it as a necessary cost, a worthwhile fee, not a punishment for being wrong.
Let's shift gears a bit and talk about how Housel explores understanding ourselves, others, and the subtle games we play with money. A core concept here is that freedom is the highest dividend money pays.
I love this part. It's so true.
This idea that the true value of money isn't just in accumulating things, but in the ability it grants you. The ability to do what you want, when you want, with who you want, for as long as you want.
That kind of control over your time, Housel argues, is priceless. It's the ultimate goal for many.
He references research by Angus Campbell showing that happiness isn't solely driven by income or status, but by having a sense of control over your life. Agency.
Yeah. And Housel's own anecdote about his brief, miserable stint in investment banking perfectly illustrates this.
Oh, he hated it.
He actually liked the work itself. It paid well. But the complete lack of control over his schedule, being dictated by his boss's whims at any hour, day or night, it made him profoundly unhappy.
He quit after only a month, didn't he?
Yeah. It shows that doing something you otherwise enjoy can feel absolutely terrible if you feel like you have no agency, no control over your own time.
Psychologists call this reactance, right?
Exactly. That feeling of being controlled triggers resistance, even if the thing you're being told to do is something you might choose freely otherwise. We just hate being told what to do.
Housel connects this to the nature of modern work compared to historical labor. Like John D. Rockefeller's main job was thinking and making decisions, internal work.
Right. But most jobs back then were physical labor with clear boundaries. When you left the factory, work was done.
Today, so many jobs are thinking jobs.
Mm-hmm.
Your primary tool, your brain, comes home with you and is always potentially on.
It blurs the lines between work and life, even if official hours might seem shorter. So control over your time becomes an increasingly valuable commodity in this environment. That freedom is huge.
Next, Housel introduces the man-in-the-car paradox.
The valet story again. Classic.
When a fancy car pulls up, you notice and admire the car itself. You rarely stop to think much about the driver or what kind of person they are.
You might think, nice car, but you don't usually think, wow, what an admirable person driving that car.
Exactly. And the paradox is that people often buy expensive things, the fancy cars, the big houses, the luxury goods, precisely because they hope to gain respect and admiration from others.
Without realizing that, more often than not, onlookers are simply admiring the object, not the person who owns it. They want the car, not necessarily to be the person driving it.
And Housel argues, pretty convincingly I think, that you'll gain far more respect and admiration through qualities like humility, kindness, and empathy than you ever will from a material possession.
It rings true, doesn't it? Which ties directly into the idea that wealth is what you don't see.
This is such a fundamental distinction the book makes. Rich versus wealthy.
Yeah. Rich is often about current income, and it's often made visible through spending the big house, the flashy car, the expensive clothes. You can see rich.
But wealth is hidden. It's income not spent. It's the assets you accumulate that provide options, flexibility, and security for the future. It's unseen financial assets.
Housel uses that story of Roger and his repossessed Porsche from his valet days.
Right. Roger looked rich driving the Porsche.
But he wasn't wealthy. He was actually deep in debt. His visible richness masked a complete lack of underlying wealth.
The problem is, our society provides countless visible role models of people who are rich people, who conspicuously spend money. It's easy to see and maybe imitate spending habits.
But it's incredibly difficult to see wealthy people because their wealth is precisely what they haven't spent. It's invisible. We see the car someone bought, not the savings they didn't touch, the investments they made quietly.
And since we learn so much by observing and imitating others, this hidden nature of wealth makes it really hard to learn the restraint and delayed gratification necessary to actually build it.
Yeah, we see the spending and we might associate it with financial success when often that very spending is the thing preventing true wealth accumulation.
Ronald Reed, the janitor with $8 million, was a wealthy role model only after he died and his hidden wealth was revealed. You couldn't learn from him while he was alive, really.
Exactly. This leads to one of Housel's most powerful points, the sheer power of saving. He argues pretty forcefully that your savings rate matters far more than your investment returns when it comes to building wealth, especially early on.
He draws that analogy to the 1970s oil crisis.
Mm-hmm. The world didn't solve the problem just by finding more oil. It was solved primarily by becoming vastly more efficient in how we use energy cars, getting double the MPG, better insulation, etc.
Efficiency was more within our control than unpredictable oil discoveries.
Exactly. Applied to personal finance, your savings rate and frugality are your version of efficiency. They are largely within your direct control, unlike unpredictable market returns, which are subject to luck and external events.
So, building wealth through a high savings rate gives you a clearer, more controllable path, less dependent on things outside yourself.
Wealth is simply accumulated leftovers after spending. You absolutely can build wealth without having a massive income, but you absolutely cannot build wealth without a high savings rate. It's mathematically necessary.
And the ability to save is deeply psychological, isn't it? linked to desire and social comparison.
Totally. A high savings rate means you spend less. And it's easier to spend less if you desire fewer material things. And it's easier to desire less if you care less about keeping up with or impressing others.
So money relies more on psychology and self-awareness here than on complicated financial theories.
It really does. And Housel's point about saving for saving's sake is crucial. You don't necessarily need a specific goal like a house down payment or an exact retirement account number. Saving just for the sake of saving creates flexibility and options for an unknown future. It buys freedom.
Which brings us to the idea that being reasonable often trumps being purely rational when it comes to money.
Ah, yes. Humans being human.
This acknowledges that we're not perfectly calculating robots, right? Something could be technically optimal in a vacuum, according to some complex formula, but completely unreasonable for a real person with emotions, biases, and crucially, the need to sleep at night.
The perfect example is Harry Markowitz, the Nobel laureate who pioneered modern portfolio theory, the complex math behind optimal diversification.
Right, the guy who basically invented the efficient frontier.
That's him. When asked how he invested his own retirement money, he said he simply split it 50-50 between stocks and bonds.
Wait, not using his own complex formula?
Nope, because that simple 50-50 allocation was the one that helped him sleep at night. It felt right to him, emotionally.
That wasn't mathematically rational, according to his own groundbreaking theories, but it was perfectly reasonable for him as a human being dealing with the uncertainty of his own financial future.
Exactly. Housel also points to that Yale study suggesting young investors should use, 2-to-1 leverage on stocks.
Whoa, leverage.
Yeah. Mathematically, the study showed that even if you got wiped out occasionally, if you just kept saving and reinvesting over a lifetime, you would likely end up better off. Technically rational, maybe.
But could any actual human psychology endure that strategy? Writing out multiple crashes where you lose everything and more? Probably not. It's completely unreasonable for a real person.
Right. And financial forecasting is another example. Most economic and market forecasts are notoriously terrible.
Yeah, they rarely get it right.
Housel notes that making them is probably reasonable because it's hard for us as humans to accept that we simply don't know what the future holds. We crave certainty.
But acting on those forecasts as if they are gospel truth, that's dangerous and often irrational.
And even Jack Bogle, the ultimate champion of low-cost, passive index investing, apparently invested some of his own money in his son's high-fee active fund.
No way, Mr. Index Fund himself.
Yeah. When asked about the inconsistency, he basically said, "We do some things for family reasons. If it's not consistent, well, life isn't always consistent."
And that rings so true, doesn't it? Life rarely adheres to perfect, cold rationality. We make emotional, reasonable choices.
Which leads to the really important idea of defining the game you're playing.
Yes. Housel argues that assets don't have one single rational price. Their value is entirely dependent on who you are and your time horizon.
The right price for a share of Google stock is completely different if you're a day trader looking to make a quick profit on momentum versus if you're a 30-year investor buying for long-term growth potential.
And a day trader buying at a valuation that seems absolutely crazy to a long-term investor isn't necessarily being irrational.
No, they're just playing a different game. They have different rules, different objectives, different time frames. It's rational for their game.
Housel argues this dynamic was heavily at play in the dot-com bubble. It wasn't only irrational exuberance.
Right. It was also fueled by the perfectly rational actions of short-term players, day traders, mutual funds with high turnover, who were playing a momentum game, not a long-term valuation game. They just wanted to ride the wave and get out.
The danger came when rising prices pulled even long-term investors, people who should have been playing a different game based on fundamentals, away from their own strategy and into that short-term frenzy. They got sucked into someone else's game.
This applies to consumer spending too, doesn't it? So much of our spending is driven by social comparison.
Keeping up with the Joneses, basically.
Yeah. We see others, often people we admire, spending money on certain things. And we think, to be like them, to be admired like them, I should spend money on those things too. We see their cars, their houses, their vacations.
But we don't see their goals, their worries, their debt levels, the context of their financial game. We just see the surface.
Housel uses the example of maybe a young lawyer spending heavily to project a certain image that's necessary for their career game.
Right.
If someone like a writer earning less tries to imitate that spending based purely on those visible cues, without having the same professional need or income context, it can lead to significant financial strain and disappointment. You're playing the wrong game for your situation.
So the critical takeaway Housel offers is define the game you are playing with your money. Understand your goals, your time horizon, your values.
And crucially, do not let your financial decisions be unduly influenced by people who are playing a completely different game than you are. Stay in your lane.
Moving into some surprising realities the book explores.
Yeah.
One is just the constant presence of the unexpected. As Scott Sagan famously said, things that have never happened before happen all the time.
It's a great quote. And the irony is, history is essentially just a long list of unexpected events. Wars, depressions, technological revolutions, pandemics, stuff nobody saw coming quite like it did.
Yet we constantly use history as if it's a perfect, rigid roadmap to predict the future.
Right. Housel argues that history is actually a pretty misleading guide in finance, precisely because it's dominated by outliers, the Great Depression, WWII, 9/11, the 2008 crisis, COVID.
These events move the needle the most, having massive, long-lasting impacts.
But by their very nature, they are almost impossible to predict. You can't forecast the black swans accurately.
And these outliers don't just happen in isolation, they compound into further unpredictable events, don't they?
Absolutely. Housel gives that example of how 9/11 led to Federal Reserve interest rate cuts, which helped fuel the housing bubble, which contributed to the 2008 financial crisis, which then led many people to seek higher education as jobs were scarce, contributing to the massive student loan debt crisis today.
Wow. It's hard to draw a straight line from 19 hijackers to trillions in student debt, but you can see the chain reaction of unexpected consequences.
Outlier events are interconnected in these really complex, unpredictable ways. History also doesn't fully account for structural changes. The financial landscape is constantly evolving.
Things like the 401k, Roth IRAs, these didn't exist for previous generations. Financial advice based on a world without these tools needs updating.
Totally. Housel notes that even Benjamin Graham's specific stock analysis techniques, while rooted in timeless principles like margin of safety, became less effective over time because the market structure itself changed. Information flows faster, etc.
So the old saw, "It's different this time," is often used mockingly.
Right, like its famous last words.
But Housel points out that in crucial ways, sometimes the world is structurally different. Things do change.
Which underscores once again the critical importance of having room for error. Not just for the risks you can foresee, but for the things you can never possibly imagine.
Like the German tanks defeated by mice chewing wires in Stalingrad. A perfect, if bizarre, historical reminder that completely unforeseen vulnerabilities exist.
Businesses face these kinds of black swan events all the time. A key supplier plant exploding, a sudden regulatory change, a shift in consumer preference, a competitor coming out of nowhere with a disruptive technology.
The defense is diversification and redundancy, avoiding single points of failure.
Yeah, having multiple suppliers, backup systems, contingency plans. Just like engineers build redundancy into airplanes and bridges, you need fail-safes.
So saving money isn't just about budgeting for known risks. It's building in a margin of safety for the unknown, the unthinkable.
House states plainly that the most important part of any financial plan is accepting that it likely won't go exactly according to plan. You have to expect surprises.
Another surprising reality Housel highlights is that you will change over time.
Your goals, your desires, your priorities, even your personality, they aren't fixed. They evolve.
He shares that anecdote of his friend who completely shifted careers against all expectations to become a doctor, finding deep fulfillment precisely in the struggle and the unexpected path.
Or the childhood dream of driving a tractor evolving into the teenage dream of becoming a lawyer. Our identity and aspirations are fluid, especially over decades.
This poses a real challenge for long-term financial plans, doesn't it? Compounding works best over decades of consistency.
Right. But how many of us actually want to do the exact same thing? Same career, same lifestyle, same investment strategy for 50, 60, 70 years?
People like Ronald Read and Warren Buffett are outliers not just in their financial results, but in their ability and apparent desire to stick to one basic approach for literally decades.
Most people don't want that kind of stability, or they find that their life goals just evolve dramatically. What mattered at 25 might not matter at 55.
So Housel suggests two things to keep in mind for long-term decisions, especially financial ones. First, avoid extreme financial plans.
Yeah, committing to a life of ultra-low income or, conversely, endlessly grueling work drastically increases the chances of future regret as you adapt and your priorities inevitably change.
He references the end of history illusion, right? Our tendency to believe we're basically finished changing, that the person we are now is the person we'll always be.
Which is almost never true. The benefits of extreme choices often wear off, but the downsides, burnout, Missed opportunities, strained relationships tend to endure.
So Housel argues for building balance into your life at every point. Moderate savings, some free time, a reasonable commute, time for family as a strategy for endurance and minimizing future regret. Don't lock yourself into something extreme.
And second, just accept that you will probably change your mind about things.
The odds of picking a career or lifestyle in your late teens or early 20s that you'll still be passionate about at traditional retirement age are actually pretty low for most people.
So building flexibility into your financial life is key. Having savings, avoiding excessive debt, it allows you to change course if your priorities shift without causing a financial disaster.
The book also delves into why pessimism seems so seductive and gets so much attention, especially in the world of money.
It does seem to grab more headlines, doesn't it?
Part of it is simply our evolutionary wiring. Loss aversion is strong. Threats feel more urgent than opportunities. It's a survival mechanism.
Makes sense. But money is also ubiquitous. Bad news about money affects almost everyone, capturing universal attention in a way that bad news in other niche areas might not.
Stock market crashes, recessions, even if you don't own stocks directly, these feel systemic, like the ground is giving way beneath you. It creates widespread anxiety.
And pessimism often sounds smarter, more sophisticated.
Yeah, why is that?
Well, it's easier to make a pessimistic forecast by simply extrapolating current problems forward. Things are bad, so they'll get worse.
Right. Optimism, on the other hand, requires imagining solutions, human adaptation, progress, which can sound naive or like you're selling something.
Housel notes that forecasters are often rewarded more for sounding confident than for actually being correct. And confident pessimism often sounds more plausible than confident optimism.
Pessimism doesn't require imagining the world changing for the better. But history shows problems incentivize solutions. People adapt. Threats lead to innovation, like fracking responding to energy scarcity.
Assuming ugly stays ugly is an easy forecast, but it overlooks human resilience and the long-term patterns of progress. It's often wrong over time.
This leads to the idea of when you'll believe anything.
This is interesting. Growth is slow because compounding takes time, right? It's gradual.
But destruction and crises can be fast, often due to single points of failure or a sudden loss of confidence. Think bank runs.
Exactly. This means pessimistic narratives often feel fresher, more immediate, and frankly easier to construct than narratives of slow, steady, sometimes boring progress. Bad news travels fast.
Housel uses that powerful analogy of an alien visitor observing the U.S. economy in 2007 versus 2009.
Right, the physical reality of the cities, the factories, the knowledge, the tools was largely the same, just 2 years apart.
But the stories people told themselves about the economy, the national mood, had shifted dramatically from optimism to deep despair, despite the underlying capabilities being mostly intact. The narrative changed everything.
This is where appealing fictions emerge. They tend to happen when smart people are faced with really high stakes but feel like they have limited control.
It's a situation where you might believe almost anything that offers a glimmer of hope or a simple explanation, even if it's not based in reality.
Housel shares that incredibly tragic story of the Yemeni father burning his sick son with a stick as a folk remedy because he had no money for a doctor.
Heartbreaking.
And his quote, "When you have no money and your son is sick, you'll believe anything. The high stakes just completely override logic. You grasp at straws."
And this plays out in finance, too. The high stakes of wanting to get rich or, maybe more powerfully, avoid losing money make people susceptible to questionable advice.
Yeah, there's a 1% chance this obscure stock tip changes your life. You want to believe.
Once you're financially and mentally invested in something, you desperately want it to be true. You might default to belief despite really low odds because the alternative is too painful.
Housel even sees things like the Federal Reserve's forecast error in 2008-2009 predicting slow growth instead of an outright painful recession as potentially a form of appealing fiction.
Because the reality was too hard to face.
Perhaps. It's incredibly difficult for policymakers to predict something as painful and politically damaging as a major recession. So the worst-case scenario they allow themselves to imagine might be an appealing fiction of just slow growth because the alternative seems unthinkable or paralyzing.
Everyone has their own internal narrative, their mental models, trying to make sense of the world and fit new information into their existing story.
And sometimes we default to appealing fictions because the unvarnished truth is too difficult, too uncertain, or just doesn't fit the story we want to tell ourselves.
Housel brings it back to that powerful medicine analogy near the end. He tells the story of Dr. Clarence Hughes back in 1931.
performing incredibly painful procedures without patient consent.
Right, because he believed there was one universal, scientifically derived right cure, and the patient's opinion or desires were basically irrelevant. Doctor knows best, period.
Modern medicine has shifted dramatically from that model, thankfully. It's about treating patients, not just diseases.
It acknowledges that patients have vastly different values, goals, and ideas about what constitutes a life worth living or what risks are worth taking. This requires informed consent, presenting options, shared decision-making.
Not dictating a single right path based only on the doctor's view.
Applied to finance, this means you won't find a single guru who can tell you the universally right thing for your money.
No magic formula.
There are universal truths about odds, risk, long-term tendencies that good financial advisors understand, but applying those truths in the right way for you.
That depends entirely on your unique goals, your history, your personality, your risk tolerance, and what you believe is worth it in your own life. It's deeply personal.
Which brings us nicely to the synthesis of all these ideas, pulling it all together.
Yeah, the big takeaways.
The core lessons that emerge are pretty powerful, I think. First, less ego, more wealth, because saving is essentially the gap between your ego and your income.
And wealth is built by suppressing that urge to spend now for future options. Wealth is hidden restraint.
Second, manage your money in a way that helps you sleep at night.
That might be the best, most personal, universal guidepost for financial decisions. It overrides chasing the absolute highest returns if those returns keep you up worrying.
Third, avoid extreme financial decisions.
Right, because your goals and desires will change over time. Building balance into your life encourages endurance and minimizes future regret. Don't go all in on something you might hate later.
Fourth, like risk, because it's necessary for long-term growth and generally pays off over time.
But be absolutely paranoid about ruinous risk, the kind that takes you completely out of the game. Survival first.
Fifth, define the game you are playing with your money.
And ignore, or at least don't be swayed by people who are playing a completely different game with the different rules and goals. Run your own race.
And finally, respect the mess.
Yeah. Understand that smart, well-meaning people can disagree fundamentally about money because their goals, their histories, their desires are just different. There's rarely a single right answer in finance, only what works for you and your unique situation.
Housel shares some personal reflections that really embody these lessons, which I thought was great.
Me too. It makes it very real.
His own financial goal, he says, has always been independence. That ability to do what he wants, when, with who, for as long as he wants.
He sees chasing maximum returns or using high leverage as kind of a game to impress others, a game with hidden risks that are just less valuable to him than having control over his time.
He tells his parents' stories starting with very little, becoming moderately well off, but crucially, maintaining a frugal mindset even as their income grew.
That high savings rate gave them independence. It allowed his father to eventually quit a high-stress ER job after 2 decades, something he couldn't have done without that financial buffer, that freedom fund.
And Housel shares his own financial choices that might look irrational on paper.
Right, like owning his house outright instead of leveraging a super low mortgage rate or keeping a relatively high percentage of cash, like close to 20% of his assets outside his house.
From a pure spreadsheet perspective, maybe that's not the most efficient use of capital. You could argue he should invest that cash or leverage the house more.
But for Housel, that cash is the oxygen of independence. It ensures he never, ever has to sell stocks at a bad time just to cover an unexpected expense.
The feeling of security and independence it provides outweighs the potential lost investment gains for him. That's his sleep at night factor.
It's such a powerful concluding point. The best financial decisions aren't always the ones that look most rational on a spreadsheet. Sometimes you have to choose between being mathematically right and being genuinely happy and secure in your own life. Reasonable over rational.
The book's postscript provides a brief but really insightful historical context for why Americans, maybe especially Americans, think about money the way they do.
Yeah, that was fascinating too. It starts with the post-WWII era. After the Depression and the war, there was this real fear of returning to economic hardship.
Understandable.
And the response, partly intentional policy, involved fostering consumption. Low interest rates, making cheap consumer credit widely available for the first time on a mass scale.
There's this perfect storm, right? Pent-up demand after years of wartime production, limiting consumer goods.
A brand new credit boom making it easy to buy now, pay later.
And hidden productivity gains from the previous decades finally being unleashed, all fueling a massive economic expansion in the 1950s.
This led to a huge buying spree: cars, appliances, new suburban homes, consumer expenditures and residential construction just soared. The American dream takes shape.
Crucially, Housel highlights that the period from roughly 1945 to 1980 was an era where economic gains were shared relatively more equally than they are today.
Right. Real incomes for the bottom 20% grew at a similar rate to the top 5%. Women and minorities also made significant, though still incomplete, gains in the workforce.
This resulted in a certain leveling out of lifestyles, Housel argues. People across different social classes drove similar kinds of cars, watched the same few television shows, consumed a similar mass culture.
Well-being was measured more against peers, whose lives felt relatively comprehensible and somewhat attainable. The gaps weren't as astronomical.
The shift really began from the 1970s onward.
Yeah.
Economic wins became less favorable, more uneven, partly due to rising global competition.
But the expectation of lifestyle equality, the idea that you should be able to live like your peers or maybe slightly better, that persisted.
And then inequality began to rise dramatically from the 1980s onward. The top 1% saw vastly higher income growth than the bottom 99%.
This led to what Housel calls the big stretch.
Explain that.
Well, rising incomes for a small group at the top allowed them to adopt these breakaway lifestyles: much larger homes, more expensive cars, private schools, elaborate vacations, things the average person couldn't realistically afford.
And everyone else watched this unfold, first through traditional media, then amplified endlessly by the internet and social media. We see these curated, often unrealistic portrayals of wealth constantly.
This created inflated aspirations for the majority, whose incomes were basically flat or growing much slower. The goalposts moved way out of reach for many.
The consequence of this expectation gap, combined with a cultural acceptance of debt that had been building for 75 years since WWII.
What was that people began stretching financially to try and keep up, or at least feel like they weren't falling too far behind.
Huge mortgages, high credit card balances, long car loans, massive student loans became commonplace. Housel points to data showing debt-to-income ratios soaring from around 60% in the early 70s to over 130% by 2007, just before the crash.
Wow, doubled. And while some debt was shed after the 2008 crisis, things like low interest rates and quantitative easing primarily boosted asset prices, which, again, disproportionately benefited the wealthy who own most of the assets.
Social media has only intensified the comparison and the envy, making the gap feel even more acute for many people.
Housel concludes that this paradigm, these inflated aspirations fueled by constant social comparison and enabled by a deep-seated cultural acceptance of debt, it's incredibly difficult to change. It's woven into the fabric now.
It contributes to a feeling that this isn't working for many people and creates this constant search for something radically different, maybe explaining some of the political and social churn we see.
It makes the present feel, as he puts it, like just one damned thing after another, reflecting how deeply ingrained these psychological and historical patterns are in shaping our financial behavior and our expectations today.
Wow, that was a truly expansive deep dive. It's really clear that managing money effectively is about so much more than just the numbers and formulas.
So much more.
It's about understanding history, psychology, acknowledging the huge roles of luck and risk, and crucially, defining what actually constitutes enough for you, or what kind of game you're personally playing in the world that's constantly showing you someone else's highlight reel.
It forces you to look inward, doesn't it? To understand your own unique financial story, your biases, and to be really mindful of the powerful external forces shaping your perspective, often without you even realizing it.
So, for you listening, maybe consider this. Given all these powerful, often invisible forces, like personal history, luck, social comparison that shape our financial decisions, what is one deeply held money belief you have that might actually be an appealing fiction, a story you tell yourself about money shaped by your own unique journey?
That's a good question to ponder.
Something to reflect on long after this deep dive is over.